people's drive is to remove uncertainty or dampen it or try and remove it as much as possible. And I think sometimes that is a mistake. You're kind of better to accept the uncertainty and kind of revel in it.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders Podcast.
Hey, it's Walter here. Welcome to the Two Traders Podcast. Darren is on the line. Hello, Darren.
Good evening, Walter.
So we're going to talk about this concept of hyperbolic discounting, Darren, which sounds like a something that your plumber would do for your pipes or something. This is like the third time you've had a clogged pipe, so you get some hyperbolic discounting or something like that. I don't know. And it's weird to me. It's, this idea, but it's actually really relevant to trading. And I've thought a lot about it. And so just for the listeners that don't know, that this is a fancy schmancy term of saying something along the lines of a bird in the hand is better than two in the bush, which is essentially the old adage that, if you've got something in hand, take it, because you never know what's going to happen in the future. And that's really what hyperbolic discounting is. It's this idea that we're more likely to value something that we have right now than to value something that could be worth a lot more, but we have to wait a little bit for it. Yeah, so that obviously comes into play with trading. Like, I think a lot about scalpers, and scalpers, to me, I'm not a scalper, so I can't really say, but to me, they have this mindset where it's like, look, I've got this profit. It's come to me rather quickly. I might as well take it now because I don't know what's going to happen in the future. That's probably not fair, because there are plenty of scalpers out there that probably also run some sort of trailing exit and let their positions go just in case, they really do go, but and provide a profit. But to me, scalping kind of sums up this idea of hyperbolic discounting. And I do believe that it is one of the biggest ones to overcome, particularly for new traders. And I'd love to get your thoughts on the issue as well.
Well, I wanted to fire a question back at you first about this. So this is basically a bias that we kind of have built into us as human beings, yeah? We kind of like the instant gratification, even if we know pretty surely that if we waited a bit longer, we'd actually get a better outcome. Is this something that is found only in adults, or would you find this in children as well? Is this something we're born with, or is it something that we've learned?
That's such a good question. And the only thing I can tell you is there's a classic, and I do mean classic, study in psychology where they took little kids. So these kids were about 4 years old, roughly. 3 to 5, I think. And they offered them the opportunity to have, and it wasn't in the context of hyperbolic discounting, but it certainly displayed this. So I think they were talking about willpower or something like that. That's how they couched it. But they put this big, juicy chocolate biscuit in front of the children. And then they say to the poor kid, they would say, you can have this biscuit right now, but if you wait 5 minutes, we'll give you 2. And so they have this awesome video of these kids sitting there, asking, well, how long has it been? What time is it? And, and then finally they break down and eat them. And it's been redone before. They give them like marshmallows and they do the same thing. And basically what they found is that most of the kids can't wait, right? So maybe they learned it before they were 4 years old. You could argue that, but it certainly seems like it's something that we see from the very young ages. So you could argue, obviously, that it's innate or nearly innate, I suppose.
Yeah, but that's kind of interesting. That are you saying that it wasn't in all kids? Some kids could wait.
That's fair enough. Yeah, that's true. But the vast majority of kids couldn't do it. They just could not wait until the 5 minutes was up to get the additional marshmallow or the additional chocolate biscuit. So it was a very small minority that was able to do that. Yeah, which is an interesting point in itself, isn't it?
Yeah, and I think with all of these kind of biases that we've got, they seem to show themselves to different degrees in different people. And I think, with trading, that is half of the problem, isn't it? You've kind of really got to decide your kind of heat map of what really pulls your strings, and then kind of work that into how you trade. So it's not only knowing that these biases exist in us and they're likely to sort of lead us down the wrong path. You've kind of got to work out which are the ones for you that really affect you the most as well. Would you agree with that?
I agree, absolutely, 100%. I do think, though, that you could also argue, like, for example, the classic experiment that they do usually in psychology courses is they'll say, rate your intelligence. Okay, so what should happen is that everyone says some people say they're a little bit below average, some people say they're a little bit above average, some people think they're really smart, and some people think they're idiots, and and it's a normal curve, right? So any random sample of humanity should basically give you a normal curve. Well, what happens invariably is that people overrate themselves, say that they're just about everyone thinks they're a little bit above average. And some of them think that they're way above average, and no one thinks they're below average. You know what I mean? And so this kind of, which is like an optimism bias. We think that it can't happen to us. So we think, yeah, well, maybe some people have hyperbolic discounting, but I don't. You know what I mean? Which is another bias in and of itself. So you could argue, while it's certainly true that not everyone is prone to hyperbolic discounting, the vast majority of people are. And if you think to yourself, well, that wouldn't happen to me, or I don't do that, that could just simply be another bias that's seeping in and failing you because it's not allowing you to consider the fact that you do succumb to hyperbolic discounting. You know what I mean? It's like this massive circular argument or confirmation bias, which of course is confirming what you believe by only paying attention that supports what you believe. So it's just crazy hall of mirrors when we get into cognitive biases. But yeah, so I would say, to me, for traders, it's a big deal. I think it's a really big deal. And I think that you have to consider it. And I think that we would, as traders, we'd have to assume that we all have this propensity. So the question would be, well, what can we do to guard against it? I suppose, if you were a trader and you started out as a trader and you were always drawn to, say, trailing exits, then maybe it's not as important to your makeup, the hyperbolic discounting cognitive bias. Maybe it's not. If you from the get-go were like, trailing exits, that makes sense to me, it's the only way to go, that's kind of like it's not really the one and only antidote to hyperbolic discounting, but it's a way of allowing you to kind of stamp that out. That's how I see it anyway.
I think half the problem is because of the environment that trading puts you in as well. If it was something like, if you were, say, at a savings account and they told you if you kept your money in for another month, you'd get a greater rate, that outcome is certain. That's a certain outcome that you're going to get more. Whereas in trading, the environment you're kind of dealing with is, that a lot of your trades will go to your perceived greater target, but it's not certain. And this might be the one that is going to come back and stop you out if you hold it longer. So that uncertainty is kind of adding to this hyperbolic discounting vibe that's going on. And so, that kind of adds, I think, it's always that uncertainty with trading that kind of highlights these biases to a much greater extent, because that from your back testing that if you hold your trades longer over a long period of trades, you're likely to do better. But it's always likely. It's never a certain thing. And I think that really plays in the back of your mind. And I think that uncertainty is what we deal with worst as humans. We really don't like that scenario.
Yeah, but that's what you get paid for as a trader, right? By putting money on the line and basically sitting out uncertainty. I mean, that's one way to look at trading, right? Is to say traders get paid for putting money on the line in the face of uncertainty. Right?
Exactly, yeah. And we hate it. And you only need to spend a couple of years studying trading and talking to other traders. You'll see that, generally people's drive is to remove uncertainty or dampen it or try and remove it as much as possible. And I think sometimes that is a mistake. You're kind of better to accept the uncertainty and kind of revel in it a bit. I see a lot of people say, this system tested great over 10 years, but there was 1 year where the drawdown was a bit high. And I think, well, if it tested great over 10 years and you had one bad year, you've really got to kind of, look at the 10 good years as much as you're looking at the one bad year. And I think sometimes that desire to remove the uncertainty can kind of throw you off something that might be really good.
Yeah, absolutely. Yeah. And looking at just that one, like if that 1 year was this year, and just focusing on that one recent year could throw you off a bad system because you go, well, it doesn't work anymore, or the market's changed now, so I'm going to scrap it.
Yeah, and I think you'd struggle to find any trader with longevity that's made a lot of money and been around a long time that's never had a really bad period where things have just gone worse than expectancy.
Absolutely. And and I'll take it a step further and say, I think it's difficult to find a trader who's gone through that and stuck with his system or her system, because those are the ones that, like Dunn Capital, right? Is it Dunn Capital, the one that you?
Yeah,
the one in Florida, those brothers. Yeah. So those guys in Florida, like, they have these down years and yet they keep pushing on. And I think for the standard, like, you're talking about the standard retail Forex trader who's been doing this for 3 years, they've hooked into a system. It goes really well. I think in most cases, if they have like 2 down months, maybe 3 down months with the system, they'll say, look, it's not working. I'm going to stop trading it. The markets have changed, or they'll change the system, add some rules or something. I just think that's really common. And I think it's uncommon to see people sit through it and just keep plugging away because they've got that real confidence that what they're doing is going to work in the long haul, and they're just in a drawdown. They're just in a really bad spot at this time, this month, this week, this year.
Yeah, sure. And that uncertainty again is playing itself out because you don't know if this bad period is just a drawdown period to be expected, or it means that your system's not working. How do you know? You're never going to know 100% with any of these elements. There has to be a kind of a leap of faith, I suppose. I'm not sure if that's the right way to describe it, but you've got to be happy with that element of risk. I think it'd be foolish to say that any system guarantees that you will never blow up. I mean, but we all try and work that as a certainty into our systems, and we're always looking to remove that uncertainty in all of the unpleasant elements. We just want the good stuff.
Yeah, and I think that's why traders typically in the beginning are drawn to high win rate systems. They're always looking to get a high win rate system. They're like, how do I improve my win rate? They're focused on the win rate because they want to be right. They don't necessarily see it as trying to make money and disregarding the win rate, because in essence, the win rate doesn't really matter. It really doesn't. Like, there are some brilliant trading systems that take a lot of losing trades, a majority of losing trades by far, but people don't want that. If you ask anybody who's offered any sort of like Forex signals, they'll tell you the same thing, which is this. As soon as they get a winning streak and they have several winning trades in a row, they'll get more subscribers come in. And as soon as they have a drawdown, a bunch of people will just dump the service, like if it's a monthly fee or something. I mean, that's just the way it goes. And it shows you this bias that we have, which is you want to be right. You don't want to, you want to have, like you say, you want to remove uncertainty. It's part of what people are looking for, which is, I understand it in the beginning because I was certainly that way too. And I'm not sitting here on saying, this is something that I had from the get-go, because I didn't. I had the same issues of trying to find systems that had high win rates. But really what it comes down to is learning how to lose, understanding your numbers and probabilities, and managing your risk, and then all the while working on yourself, and then making sure that you understand that you're not in control of this. You are not in control of what's going to happen for the next trade. You have no idea, and there's nothing you can do. And like you say, you've got to embrace that. I think there was 1 year, I think it was about 3 or 4 years ago, where my New Year's resolution, Darren, was to embrace the uncertainty. Like, that was literally what I wrote down. I was like, I'm going to live in the moment. I'm going to love. And there's this famous lawyer in the United States. I'll put him in the show notes here. His name is Jerry Spence, and he famously never lost a case. He was a defense attorney, and he had all these clients, and he never lost a case. And one of the things he said in his book was, he probably has several books, but I only read one of them, was that, part of being alive is having that uncertainty and that fear in life that like gives you, and I think adrenaline junkies are kind of after that, like people jump off cliff faces in a squirrel suit or whatever, you know what I mean? Like, I think that's kind of what they're after. They're after this to feel alive. And that's kind of what trading gives you. That's what gambling gives you, I suppose. It's this feeling of embracing the uncertainty of not knowing what's going to happen next.
So this hyperbolic discounting means that we'd rather take $1 now rather than wait a day and get $2. We'd rather, in effect, take quick profits. So are we kind of going down the route here of saying that in trading that is definitely the wrong way to do it? And if it's as uncertain as we say it is, then how do we know for certain that that is the wrong way to do it? How do we know that taking quick profits now, even though, you know, a lot of your trades run further, is not the best way to go about it?
Yeah, well, that's a great question. To me, it's not that it's the wrong way to do it. Like, certainly there are people that can risk 20 pips and take 5 pip profits all day long and they make money at it because they're really good at, they have a high win rate and they do really well. But I think it's kind of like the shotgun theory, right? If you're trying to shoot something in the forest and you have a 22, I'm not a big gun guy, but if you have like a 22 rifle, which I think has like this little tiny bullet, or you have the shotgun that has all these pellets that just spray out of it, and you want to shoot something, you're probably going to be better off with the shotgun in most cases, depending on how close it is or whatever to you when you're shooting. So it's kind of like that with trading. If you have a really high, big, fat winner, it almost allows you to be a little bit sloppy on your execution. Like if you're not that good, if you make some mistakes, if you run into troubles over time, but your winners are 3 times bigger than your losers, it allows you a little bit of wiggle room. Whereas the reverse is not true, right? It's just not true. If you're risking 20 pips to make 5 pips on your trades, you better be sharp and you better have something that works and gives you an 80% win rate, or you're in big trouble. So to me, that's how I see it. I'm not saying I don't think it's the only way to go, but I think it allows you to be a little bit more sloppy, I guess, in your execution, which is it's not saying that you shouldn't execute as best you can, but I think that's kind of the thing.
Yeah. Well, you know, that could be your decision making, the execution of your decision making as well. I mean, if you don't need to be right all the time with your decision making and can still make profit, that's more realistic, knowing, you know, how bad we are at making good decisions consistently. So are we kind of saying that the probabilities are slightly better for higher risk to reward trading?
Well, obviously you don't have to win as often, right? So if you have the 50-50, if you're close to 50-50 or 40-60 or whatever it is, or 60-40, then, you know, having those higher winners, those bigger winners, just allows you to live longer. But there is another aspect to this that's kind of interesting with hyperbolic discounting, which is basically it's a law of diminishing returns too. So if I said, for example, hey, Darren, on this next trade, you can make £500 today, or if you wait another 3 days, you might make £1,500, right? Versus if I said, Darren, you're going to make £500 today if you close out the trade, or if you wait 7 months, you might make £1,500. See, what happens is this curve, and I'll post it in the show notes too for everyone to see, but there's this curve that basically says, because a hyperbolic curve is one that goes up really quickly and then kind of flattens out, and you'll see it in the show notes far off. But basically, the idea is that if it's really, really far off in the future, the impact of the additional possible profit or possible reward is dampened and basically is gone. Yeah. So it's kind of interesting, isn't it? Yeah.
That's probably why we're kind of drawn to slightly shorter time frames as well.
I would say so. Exactly. Yeah. That makes sense to me too. Exactly. We want the.
Yeah.
Yeah.
I mean, it does make you wonder how many of these trading decisions we make are kind of purely based on the fact that we just kind of want all the sweet stuff, and we're kind of glossing over the actual facts of what's really going to go on. And we're just saying, well, you know, that kind of looks pretty nice to me. That's going to feel nice trading that. and that's what we end up trading, you know, because we do kind of group together, don't we, and trade the same sort of things, the same sort of instruments, the same time frames. It's to find people outside the curve of the norm in trading.
Yeah, absolutely. I remember hearing about a guy who had all these automated systems, and every week he would choose a few. So he'd have like 2,000, 5,000 systems, and every week he would just choose the few that had been performing really well. And I remember thinking, wow, that's interesting. Like, who does that? You know, that sort of thing. You know, there aren't many traders that you hear doing stuff like that. But you're right. We tend to sort of flock together, and everyone sort of pats each other on the back and says, hey, you're doing a good thing, you know, because I'm doing something very similar to what you do.
Yeah.
You're not going to grow that way, are you? Yeah.
No. And we've talked about this a lot in the podcast, about how we are drawn to what's comfortable, and you know it's so often the bad decision to make.
Yeah, absolutely. Yeah, it's almost like a test. Is it something that you feel comfortable with? Okay, then maybe you shouldn't be doing it.
Yeah, or at least question it and kind of, you know, question your beliefs on it and look at your facts again as well. Because I think quite often we've kind of predetermined in our mind that like something uncomfortable, say like 5-to-1 risk to reward, that's holding most of your trades for a pretty long time. And most people will find that uncomfortable, and you know, we'll kind of gloss over that, and maybe even if we do back test it, we'll do it with slightly less enthusiasm and kind of not really check the figures and decide fairly quickly that that doesn't work, just to kind of avoid, you know, the finding out that what's really uncomfortable is, you know, might be one of the better ways to trade. You know?
Yeah, absolutely. So I'm thinking about this, like in terms of the way that you trade, because so much emphasis is on the exit and exiting the trade. Is this something that you think about, like in terms of, am I taking profit too early, or do you know what I mean? Like, how does this come into your thinking?
I nearly always take profit too early. I'd say 1 in 100 I take, you know, I hold on for that bit longer, but I've progressively got better and better at it, so it's less of a defining element of my trading now. So, you know, when I first started out trading, I was always taking profit way too early, and now I'm taking it a little bit earlier than I should be. And I've got better as time's gone on. And also what I've done is I've kind of stretched my target beyond where it needs to be. So let's say I want to aim for 3-to-1 risk to reward. I'm setting my target at 4-to-1. So I'm not quite getting to my 4-to-1 target, but I'm still getting over my 3-to-1 target. So I'm kind of tricking myself, basically. I know it's a lie, but I'm playing along with the bias, and I'm saying, okay, well, this is what my brain's going to try and do to me. So I'm going to trick it. I'm going to sort of, you know, it's like the snooze button, is where people set the alarm every 5 minutes, and I'm just trying to kind of work with that bias rather than saying, well, I need to eradicate it completely. And the other thing I've done is the way I trade now. I looked at my stats the other day. I'm in a trade 94% of the time. So that feeling of being in a trade and the outcome being significant has kind of gone now, because I'm always in a trade. I'm always in a few trades. So I think I've subconsciously kind of worked that in to deal with that emotion as well. And because I'm always in a trade now, it doesn't feel as important, the getting out of a trade. And that's never really like a completion for me. It's just like a rolling, continual trade, you know.
Wow, that's fascinating. Yeah. It's almost like desensitization. Like if someone were to take, like my friend Dennis, he takes about 1, maybe 2 trades a month. And you would compare him to someone like you, where you've taken so many trades and you're almost literally always in the market. It would seem like it wouldn't be as stressful, or as, you know, it wouldn't affect your decision making, I suppose, as much, because you're always kind of at that homeostasis point, which is, I'm in a trade. You know what I mean?
Yeah, sure. And the same with the entry as well, because my entries essentially come at the close of every bar. It's not like I'm making a significant decision. It's like bar's closed, I set my entry, I go back about my business. And so, I'm not saying that is a brilliant way to trade, but it's a system modelled around getting the best from me and avoiding the worst of me. So I've kind of found things I liked and slowly modelled them so I don't make the same stupid mistakes that I usually make. I don't know whether that's a good way to go about it either. That's just what I have done.
Yeah. I think it's saying, well, your results are going well, so it seems to be working. I mean, what else? Yeah, I mean, and you're not, it's not like you don't lose sleep over it. You don't feel like you're doing the wrong thing. You feel like you've kind of hit it, even though you know that you're probably not going to go all the way to the 4-to-1 target, but you're kind of tricking yourself. I think a lot of traders do a similar thing with performance goals. Like if they say, look, I want to make X percentage, let's say they want to make 5% this month, they might really be okay if they make 3% or something like that, right? And kind of, it's like a goal, and if they hit it, maybe they stop trading or something like that because they're scared they're going to give it back, and then they reset next month and start all over. But they're kind of okay thinking, look, if I made 3% a month, that's 36% a year, and I'm okay with that, that sort of thing. Yeah.
The thing you do need to watch out for, though, is you're always going to have that crappy feeling afterwards that you took profit. That's always going to be there, even if you're making a sufficient amount to make regular profit. I did it just last night. I closed out some trades. They were at my target. There was nothing wrong with closing them there, but price continued to fall all night, and I felt really bad about it. And I achieved really what I needed to achieve from the trades, but I still had that bad feeling. So you need to be aware of that, and you also need to be aware of acting out that feeling. Because I do remember in the past I'd do that, and then I'd kind of say, oh, I'll jump back in here, and then you end up in a right mess, because now you're just kind of freelancing and throwing money around. And so you do need to be aware that you are going to feel bad. Even if you hit your target, you're always going to have that feeling.
Yeah, that's right. Yeah, that's true. The only thing that I can say to that, and it still doesn't, I mean, it can help in some ways, is if you put your, you spread your bets on all of them. So you say, I've got a target, I've got an aggressive target, I've got an easy target, I've got a trailing exit, those sort of things. If you start to split up your positions, but in that case, you're still going to say, look, it's great that I had this, little tiny position that I left on the trailing exit, but wouldn't have been great if I had all of it on the trailing exit, right? I mean, that's the other side of that. So even when you do that, you're still going to feel like, I should have put it all on the trailing exit. Yeah. You're
always going to find something to regret.
Yeah, exactly. Can I ask you something just as an aside, because this is kind of related to this tangentially, which is, so two situations. You have a situation where you, like this, like we were talking about, like you have a trade, you took the trade, and then you got out of the trade and you made a profit, but then it kept going like exponentially past the amount. You made 100 pips, but it went another 300 pips, for example. Okay, so that's situation one. And then situation two is the trade that you saw, but you didn't take it for whatever reason. And then later on, you see that it went, as far as your target or whatever. Which one of those, situation one or situation two, would be more difficult for you to deal with?
For me, it's not taking the trade. Because, when you're in a trade and you've got profit on the table, you've got real facts to base a decision on there. You've taken a trade, it's gone your way, you've got a choice whether to take the profit or not. You've got real data to work on there. When a valid trade sets up and you leave it, then you really, if it's a valid trade, then really you're just basing a decision on a feeling, and a feeling of fear or anxiety or uncertainty, and those mistakes are much easier to avoid. And I think if you want to make your living from a trader, you need to learn to avoid making the easy mistakes, if nothing else.
Right, which is not taking a trade when it's there.
Yeah, I mean, if it's a valid trade, if you've got real data to say that you should leave this trade, then it isn't really a valid trade in my eyes. But I still do it, I did a couple the other week. I left 2 trades. purely because I was a bit uncomfortable with the current situation of my trades. I left 2 valid trades, and they both went straight to TP, and that hurts a lot more.
Yeah, I agree. I'm of the same way, because I think you can kind of talk yourself out of the one where it went another 300%. You can say, well, I got something out of it, right?
That's going to happen, isn't it?
Yeah, exactly. But the one that you saw, and then for whatever reason you didn't take, and then you come back and look at it and you go, oh my, those are just absolutely. And my theory on this is that we're kind of wired as traders to seek opportunity, and that's kind of the core of what draws us to trading is seeking out these opportunities. And I think that's why it hurts so bad, because it's an opportunity that we had and we just let it slip through our fingers, and it's just so painful. But yeah, I agree. I think situation 2 is the one that I really don't like.
Yeah. Is that kind of hyperbolic discounting there, because you're kind of looking at avoiding an opportunity, where it's a valid setup and the potential, and you should know the probabilities of that going to profit, but you'd rather just kind of take the missed opportunity than that possibility of a loser.
Yeah. So
is it kind of the same thing? Yeah.
I guess it would be, because you're kind of defending your account, right? You're sort of saying, well, I'd rather keep the money I've got in my hand than put it at risk for this additional trade. Yeah, I mean, to me, it seems kind of weird, like that you would, and I do it, and I have done it, and I did it, I don't know, about 5 weeks ago I did one, and it really killed me too, because when I woke up in the morning, I saw it, and I told myself, oh, I forgot to place it, or, whatever, I passed out, or I got stuck, eating ice cream late at night, and I forgot about taking my trade, because I do my trading at night, right? And so sometimes I'm just, doing other things, watching YouTube videos or whatever, and I was like, when I woke up and I saw that one, it just killed me, and I do think it is such a difficult thing to get over as a trader, because my theory is that's what we do. We look for opportunity. Yeah.
I find that when I do my recap videos of the week and I go back through the week, I find that these trades where I made a decision mistake, based on fear or whatever, just when I'm kind of upfront and honest about that in the videos, I find that as kind of a cleansing thing, and I find that over time that it reduces the amount of those mistakes I've made. So in a way, sort of coming out and sort of verbally expressing, look, this is what happened here. It was a valid trade. And rather than coming up with some sort of crap excuse, because, this news was coming out or whatever. If I'm upfront and say, look, this is a valid trade. I didn't take it because I was scared. That kind of expressing that emotion means that next time it's not as, I don't get it as strong.
Yeah, I agree. But the key here is you have to be honest, like you say, and you also have to be open to. I think it's useful if there's like a two-way interaction. Like you have to be open to people questioning you. You know what I mean?
Yeah, sure.
Like that helps too, because people say, "Why did you do that? Well, why wasn't this a valid trade? Or why did you do that? Or why did you do this? I don't understand this." I think that's helpful because it makes you reconsider your approach. Yeah. Okay. All right. Cool. Well, this has been a really good episode, Darren. I thank you for your time, and we'll see you next time.
Cool, Walter. I'll see you soon.
Bye.